Hi, I promised you some helps on these chapters, so let's look at some of the exercises at the back of chapter 11, starting on page 537. The first thing we're going to look at is exercise 11-1, which looks at a payback period for capital investments. Now, as you know, a capital investment is something that a company buys that is either going to help them make more money or help reduce their cost. It's a large item, and the thing that a company wants to do before making the purchase is determine if the purchase is worth it. Are we going to make more by making this investment than we would if we invested our money elsewhere? Now, one of the simple ways to look at this is the payback period. This is simply looking at the length of time that it takes for a project to recover the initial cost from the net cash inflows that it generates. Okay, so if I buy a $50,000 item, how many years of inflows, net inflows, is it going to take before I have paid off that investment? And then, am I going to make any money on it? Am I going to be able to make the percentage that I had hoped to make? So the first thing I want to look at is the payback period. So looking at exercise 11-1, we've been given some information that a design firm is going to be looking at something that will have cash outflows in year 1 of $15,000 and in year 2 of $8,000. It's going to have varying cash inflows, so we're going to have to determine how many years it will take before we have recovered our investment. So our investment in year 1 is $15,000, and this is all coming from the chart that is listed in exercise 1. And we know in year 2 we have an investment of $8,000. In year 1, our cash inflow is $1,000. So our unrecovered investment at that point would be $14,000. Let me make these cells so they're actually showing us dollar amounts. In year 2, our cash inflow is $2,000. Now, we have to add the additional investment of $8,000 to our unrecovered investment of $14,000. So we have $22,000. And we're going to subtract our cash inflow of $2,000. So our unrecovered investment at this point becomes $20,000. From that point on, we have no further investments, so we're just looking at our cash inflow. Year 3, our inflow is $2,500, which now reduces our unrecovered investment to $17,500. Year 4, we have an inflow of $4,000, so our unrecovered amount is now down to $13,500. In year 5, our inflow is $5,000, so now we're down to $8,500. In year 6, we have an inflow of $6,000, so we're left with $2,500. In year 7, our inflow is $5,000, which more than covers our unrecovered investment. And from there on out, our inflows are actually monies that we don't need because, or it's not that we don't need them, we don't need them to pay back our original investment because we have now covered our original investment. And in fact, from our original investment, we have also now recovered, or not recovered, but made over and above our original investment, we've made $17,500. And that's important. So question 2 said, would the payback period be affected if the cash inflow in the last year were several times as large? No, the payback period would not be different because we have paid back our investment prior to that last year of inflows. Okay, for our second problem, we're looking at exercise 11-2. Now 11-2 is looking at present value. The first exercise did not consider the time value of money. What does that mean? Well, if you have $1 today, is it equal to $1 you might have 5 years in the future? And the answer is the dollar today is actually worth more than the dollar you might get 5 years in the future. Because you can take that dollar today and invest it, and in 5 years have more than $1. So the dollar today is worth more than $1 in the future because you can invest it. So that's the time value of money. When we're looking at the net present value, we're taking each year and we're discounting those dollars, the cash inflows, to the present value. Meaning, if I were able to have $1 in the future, what would I need to invest today to have that dollar in the future? So if I want $1 in 2 years, maybe I would need to invest 95 cents today. The discounting allows us to determine and look at dollars in their present value rather than without taking into consideration the time value of money. In the appendix, there are 2 charts that are used, the present value tables and the present value of an annuity. So those tables are important when we're looking at the present value method of looking at whether capital investments are something we want to do or not. So, in exercise 11-2, the Kunkel Company is considering the purchase of a $27,000 machine that would reduce operating costs by $7,000 a year. Now, note it's not going to increase the revenue, but by reducing the cost, we're still going to increase our profits. At the end of the 5-year useful life, it will have 0 scrap value. The company's required rate of return is 12%. So we need to determine the net present value of the investment in the machine. So the first thing we want to look at is the purchase of the machine, which is $27,000. And let's get these all set so we have our Okay, now when we're looking at present, our discount factor, that is where you would go to the present value tables and look up your discount factor. But when it's in the current year, your discount factor is always 1. So the present value of our cash outflow, the purchase of the machine, is the actual $27,000. So now let's look at the next year. We will have no more outflows. We don't have any additional purchases. So from here on out, it's going to be that we're reducing our operating costs by $7,000 per year. Not 70, 7. Got carried away with my zeros there. And our total cash flow is $7,000 because we don't have any additional outflows or inflows to be concerned about in this problem. So we need to look at our discount factor. So what do we do? If you go to the present value table, which is in the appendix, it would be on page 554 in the appendix at the end of chapter 11. And if you look across the top to where you find the 12%, which is what we were told is the required investment return, and then period 1, you will see that our factor is 0.893. I'm going to need to add another decimal place here. And so to calculate our present value, we're going to multiply our $7,000 cash flow by our discount factor. So we'll have equals this times this to get 6,251 as the present value of that $7,000. What that's telling you is if I had invested $7,000 now at the end of year 1 with a 12% rate of return, if I had invested $6,251 today with an investment rate of 12%, at the end of year 1, I would have $7,000. We will do that same thing for each of the next years. So our discount rate for year 2 is 0.797. The next year is 0.712. The next year is 0.636 and 0.567. And then we'll just copy our formula across to get our present value for all the years. And there we have our present values. And our net present value is calculated by summing this row. Okay, I didn't do that equation correctly, did I? Equals the sum of, here we go. So there's our net present value of all of those factors. And in part 2 of the problem, what's the difference between the total undiscounted cash inflows and cash outflows over the entire life of the machine? Well, we know that our annual savings was $7,000 for 5 years, so our total cash flow was equals 7,000 times 5, 35,000. Our initial investment was 27,000. So our net cash flow is the sum of those two. And our net undiscounted cash flow is $8,000. And that is an example of calculating the net present value. It is a little confusing using the present value tables, but if you understand we're converting $1 in the future to what we would need to invest today to get that dollar in the future, it helps a little bit when you're considering what you are doing here. Now we're going to look at exercise 11-3. 11-3 is looking at ranking of investment projects. If you've read your chapter, which I hope you have, you will remember that there were a couple things we looked at: screening decisions and then preference decisions. The first two problems we've worked on have helped us with screening, deciding if the proposal is acceptable. Well, once we've decided that, we may wind up with several proposals that are acceptable, so we need to rank them in order of preference. And that's what this will help us to do. So this is problem 11-3 on page 538. On that page, you have been given some information concerning 4 investment proposals. We've got the investment required, the present value of cash inflows, the net present value, and life of the project. So we want to compute the profitability index, and then we can rank the items. So by looking at this, project A, our net present value is $36,000. Okay. Our investment was $90,000. And to get our profitability index, we want to divide our net present value by our investment. So we'll divide 36,000 by 90,000 to get a profitability index of 0.40. So we'll look at the next problems. B, our net present value was 38,000 and our investment was 100,000. Not enough zeros that time. Okay, and then we can just carry our equation down. And project C was 35,000 with investment of 70,000. And project D was net present value of 40,000 with an investment of 120,000. We can now rank our projects because we have the profitability index. And if we're ranking, we need to change. It's no longer A, B, C, D here. Our most profitable one is C at 0.50. Next we have A, which is 0.40. And after that we have B, which is 0.38. And last of all, the least profitable is D, which is 0.33. So now, when it's just a matter of ranking and taking the one that is most profitable, we can see by doing this index that our most profitable proposal was C, and we'll lean in that direction. Okay, now let's look at exercise 11-4. This exercise is looking at simple rate of return. I Have the wrong title on this page, so we'll fix that. The simple rate of return is just a real down and dirty method of determining what your rate of return is going to be. Now that was a very clear explanation, wasn't it? Computing the simple rate of return is fairly simple, and again, that's why it's called the simple rate of return, but it suffers from some limitations. It's focusing on accounting and not cash flows. And we know that in a business, you must have both profit as well as cash flows for a company to be successful. And if you're simply looking at the accounting piece of it and not considering the cash flows, you may be missing a very, very important factor. In addition, it does not involve discounting the cash flows. It's assuming that cash flows in 10 years is equal to a cash flow today. So why do we bother to use it at all? Because it's a simple way to say, well, this project might be worth looking into. Let's look further. So it's an important piece. We can use this to determine if we really want to get into some of the other computations that we've talked about. So, on page 538, we are told, the management of Ballard Microbrew is considering the purchase of an automated bottling machine for $120,000. It would replace an old piece of equipment that costs $30,000 a year to operate, and the new machine would cost $12,000 per year to operate. The old machine currently in use could be sold for a scrap value of $40,000. The new machine would have a useful life of 10 years with no salvage value. Well, we've got a lot of information. Let's see what we can do with it. So first of all, we're going to look at the operating cost of the old machine, and we were told that was $30,000. Now, the operating cost of the new machine is $12,000, and you see our equation tells us less the operating cost of the new machine and less the annual depreciation. Well, let's see. The problem didn't tell me any depreciation. Oh, but it did tell me the purchase price was $120,000. There was no salvage value, and its useful life is 10 years. I can calculate depreciation now. 120,000 divided by 10 gives me annual depreciation of $12,000. So the annual incremental net operating income is the total of those three items. So we're going to have additional net operating income of $6,000. Cost of the new machine is the second part so that we can calculate the simple rate of return. Cost of the new machine was $120,000. The scrap value, which we reduced, so we reduced the cost of the new machine. The scrap value is $40,000. So our initial investment is the sum of those two is $80,000. So the simple rate of return is the annual incremental net operating income divided by the initial investment. So that would be 6,000 divided by 80,000. So if we do that, equals 6,000 divided by 80,000. Our simple rate of return is 0.075, which equals 7.5%. Because generally, when you're talking about rate of return, it is a percentage and not the decimal. So we just converted the decimal to our percentage rate. So simple rate of return on a down and dirty way to calculate is 7.5. Does that fall within the parameters of what we require from any investment? Okay, I hope going over these 4 problems have helped. I will try to do some additional recordings for you, and please let me know if there's anything in particular that you need help with. Thanks so much.